Hello, and welcome to the May Market Navigator update from Benup Capital. If there's one word to describe April in the markets, it's resilience. Geopolitical tensions haven't faded, the economic picture remains mixed, and yet markets pushed higher, powered by an earnings season that reminded us just how adaptable and strong corporate fundamentals can be. I'm Michael Cochran, and I'm glad you're with me today as we break down recent activity and what we're watching ahead. April serves as a powerful reminder that markets are capable of staging significant recoveries even when investor concerns remain elevated. Despite an ongoing conflict in the Middle East, major indices climbed to new all-time highs during the month. The S&P 500 posted a gain of 10.4% in April alone, one of the strongest monthly performances in its history. In many ways, this echoes the tariff-driven volatility and subsequent rebound we saw about a year ago. This does not mean that markets will move higher without interruption. Geopolitical uncertainty, a leadership transition at the Federal Reserve, and elevated energy prices are likely to generate headlines in the months ahead. What April reinforces, however, is that maintaining a well constructed portfolio aligned with long term financial goals remains the most prudent approach, regardless of how difficult the near term environment may be. The strength of April's market gains may appear surprising against a backdrop of geopolitical tension and policy uncertainty. History, however, shows that some of the most notable monthly gains have come precisely when investor sentiment was most cautious, a pattern visible after the 2020 pandemic shock, the 2022 inflation driven bear market, and the tariff related pullback of early 2025. Such rebounds are never guaranteed, but they tend to occur when least expected. Combined with negative returns in the first quarter, the S&P 500 is now positive for the year. Since 1928, the market has posted positive annual returns in roughly two-thirds of years, and since 1980, that figure rises to approximately three-quarters. This underscores the difficulty of timing the market and highlights why staying invested through periods of uncertainty has historically been rewarded over the long term. Shifting gears, the Federal Reserve held its key policy rate steady in April at 3.5% to 3.75%. Though 4 of 12 voting members dissented, the most since 1992, reflecting a committee pulled in two directions: a softening labor market arguing for cuts, and oil driven inflation near the Strait of Hormuz arguing against them, leaving markets roughly split on the next move. It was also Jerome Powell's final press conference as Fed chair, with Kevin Warsh having cleared the Senate Banking Committee as his successor. And while leadership transitions bring uncertainty, markets have navigated many Fed chairs and policy environments successfully, which is precisely what a well diversified portfolio is built to do. Oil prices remain one of the most direct ways in which the conflict in Iran affects consumers and investors alike. Brent crude and West Texas Intermediate prices moved back towards recent highs in April as the Strait of Hormuz remained effectively closed to oil shipping. False starts on ceasefire and peace negotiations contributed to significant price swings throughout the month. On the earnings front, there's a genuine bright spot. As of May 5th, 2026, first quarter earnings growth for S&P 500 companies is estimated to be up to 20% year over year. This improvement is largely driven by technology investment, AI productivity gains, and fiscal stimulus. Fueling that further, AI hyperscalers such as Microsoft, Amazon, and Google have raised their 2026 capital investment plans by more than $200 billion to over $725 billion, a massive tailwind for companies building out AI infrastructure, particularly in semiconductors. Geopolitical risks and energy price swings can create short term noise, but over time, it's earnings growth that sustains stock prices, and right now, that foundation looks strong. Despite higher energy costs, equity markets have held up well. The most pressing concern is whether elevated oil and gasoline prices will begin to filter through to broader inflation via higher transportation and input costs for businesses. History does offer some reassurance. The 2022 spike in U.S. gasoline prices above $5 per gallon proved temporary as supply conditions improved. Additionally, the U.S. remains the world's largest producer of oil and natural gas, providing a degree of insulation from global supply disruptions. As always, we're here to help you navigate whatever comes next. If you've had any changes to outside accounts or experienced any significant life or financial changes, we'd love the opportunity to connect and make sure your plan reflects where you are today. This continues to be a busy, fast-moving year, and staying aligned has never been more important. We also encourage you to follow us on social media, where we regularly share timely updates, market insights, and planning ideas between these videos. And if you find these resources valuable, please share them with a friend or family member who might benefit. Thank you for your continued trust, and we look forward to speaking with you soon.